Howdy, y'all. Welcome to Liberty Call. I am Raymond Dahlman, your humble host, and today is Tuesday, August 8th, 2023. I hope everybody's had a fantastical day out there in the interwebs. It's a beautiful sunny day here in Colorado. Got a little bit of clouds. We might get a little bit of a rain. Had some sprinkles yesterday. As far as the markets, ugly today. I'm seeing red domestically, Europe, Asia. Not real pretty, unfortunately. So if it's your first time watching Liberty Call, I'm glad you're here. Thank you very much. Please give me some thumbs up, like, share, subscribes, follows, hit the notification bell. I would greatly appreciate it. And let's go ahead and jump into the numbers for today, even though they're ugly as a redheaded stepchild. All right. Dow Jones was down 0.45%, 158 points. I think it was down over 300 at one point. Closed at 35,314. S&P 500 was down 0.43%, closed at 44.99. NASDAQ down 0.79%, closed at 13,884. The VIX was up 1.4% today. It's currently at 15.99. Canada was down 0.15%. Brazil was down 0.26%, and Mexico was down 0.61%. Our friends over in Europe, Germany was down 1.1%. The UK was down 0.36%. France down 0.69%. Netherlands down 2/3%. Spain down 0.61%. Italy down 2.12%. Switzerland down 0.45%. And Portugal down 0.08%. Russian exchanges were mixed today. The MOEX mostly flat at up 0.04%. The RTSI down 1.69%. And the overnights in Asia, the Nikkei in Japan was up 0.27%. Australia flat at up 0.03%. New Zealand down 0.35%. In China, the Shanghai was down 0.25%. Let's see, Shenzhen Component down 0.42%. The China A50 down 0.16%. DJ Shanghai down 0.32%. The Hang Seng down 1.78%. And the Taiwan weighted came in up 0.9%. So just one of those weird outliers out there. So anyways, like I said, it's an ugly day. My personal feeling is that, people are kind of trying to figure out which way is the market going up, going down. So, is it, I have my own personal beliefs just based upon the big picture of things, but, the markets have been, holding on to their values. I think a lot of it has to do with the rest of the world's kind of crashing down around, and people need a place to put their money. So the U.S. markets, unfortunately, most people feel that those are the safer markets, but, we shall see. All right, let's go ahead and jump into the market recap. S&P 500 slips as banks stumble on ratings downgrade. All right, the S&P 500 experienced a significant decline on Tuesday, driven by concerns over the financial sector after credit rating agency Moody's downgraded the debt ratings of several U.S. banks due to profit-related worries. Moody's lowered the ratings of 10 banks by one level and placed 6, including U.S. Bancorp and State Street, under review for potential downgrades. The agency cited pressures on profitability as evidenced by second quarter results, indicating diminishing capacity to generate internal capital. This downgrade had a particular impact on banks such as Bank of America, Huntington Bancshares, and Citizens Bank, all of which witnessed declines of around 3%. Meanwhile, the tech sector was also under pressure due to lingering concerns about the valuation and rising treasury yields. Prominent tech companies like Meta and Microsoft faced setbacks, while semiconductor stocks experienced a more than 1% drop, led by declines in AMD, Marvell Technology, and Novanta. Novanta Inc., a semiconductor equipment manufacturer, saw its shares plummet by over 11%, following a cut in its annual guidance. The company attributed the downgrades to headwinds, including reduced IT infrastructure spending and weakness in the Chinese market, expected to intensify in the latter half of the year. Chegg Inc., on the other hand, reported positive news, announcing better than expected quarterly revenue and revealing plans to expand into generative artificial intelligence to counteract the challenge from ChatGPT. The move pushed Chegg shares up by more than 5%, although some analysts expressed the need for further evidence that such a strategy would indeed boost demand. Beyond Meat, a plant-based meat company, I like cow-based meat. That's just me. Face a different fate, with its shares dropping over 16% due to second quarter revenue falling short of estimates. Declining demand for plant-based meat in the U.S. was cited as the primary reason for this disappointing outcome, and because it tastes like dog crap. Dish Network Corporation also made headlines by announcing a merger with satellite operator EchoStar, creating a wireless connectivity company valued at approximately $6 billion. The merger reunites the two companies, which initially separated in 2008 with Dish's spinoff from EchoStar. The consolidation aims to integrate Dish's satellite services, streaming offerings, and 5G network with EchoStar's satellite infrastructure. All right. Well, that's the news from the markets for today. Let's dive into some more, I don't know, not so much good news. U.S. credit card debt tops $1 trillion. Overall consumer debt is little changed. So what are they doing? Just transferring balances over? Americans set a new record for credit card borrowing in the last quarter, as reported by the New York Federal Reserve Bank. Credit card balances surged by $45 billion, exceeding $1 trillion for the first time, primarily due to robust consumer spending and higher prices associated with inflation. Despite this, overall household debt levels remained largely unchanged, inching up by 0.1% to $17.06 trillion. Mortgage balances, typically a significant portion of household debt, showed little change, causing household debt to remain steady. However, credit card delinquencies reached an 11-year peak, measured by a four-quarter average. And in my experience, having been a debt collector and recovery agent for the better part of a decade after I got out of the military, when credit card delinquencies go up, that usually is not a good sign for the economy. I mean, sitting in those works or call centers back in those days, I mean, you could kind of tell how the economy was going by how large your queues got, as far as, not so much the 1 and 2 months late, but the 4, 5, and 6 month late queues. When they would really start to expand, you could really tell that the economy was hitting the skids. All right, where was I? The data showed a more encouraging picture when considering the quarter-to-quarter trend, with a leveling out closer to pre-pandemic levels over the last 2 quarters. Researchers at the New York Fed emphasized that despite various challenges such as higher interest rates, post-pandemic inflation, and recent banking issues, there was limited evidence of widespread financial distress among consumers. They noted that household credit was demonstrating early signs of stabilizing at pre-pandemic levels, although with higher nominal balances. While rising balances could pose difficulties for some borrowers, the New York Fed researchers also acknowledged that student loan borrowers might face constraints as student loan repayments resume in the upcoming fall. Student loan balances declined by $35 billion to $1.57 trillion in the second quarter, attributed partly to the timing of the academic year and certain minor forgiveness programs. The report indicated that mortgage originations rebounded to $393 billion in the second quarter, compared to the previous quarter's 9-year low of approximately $324 billion. However, these figures still lag behind pre-pandemic averages due to the U.S. Central Bank's aggressive interest rate hikes over the past year. Yeah, those evil central bankers. Auto loan balances continued their upward trajectory, rising by $20 billion to $1.58 trillion in the second quarter. Origination saw an 11% increase to $179 billion, reflecting the considerable surge in car prices. Although the number of newly opened loans remained below pre-pandemic levels, the New York Fed's report indicated a persistent increase in auto loan balances. So balances are going up. The number of accounts is staying fairly level. So what it appears to me, again, just speculating here, is that people are living off their credit cards right now. That would be my guess. All right, last up, something I was normally cover on Mondays, the Monday morning outlook from Brian Westbury, the chief economist at First Trust. And this went out yesterday. It's titled, "Here's Something to Fitch About." It's talking about the U.S. downgrade of debt. All right, where am I? Here we are. The Mega Millions lottery jackpot has reached an unprecedented $1.55 billion, prompting a thought-provoking perspective on the odds and financial responsibility. Despite the allure of the lottery's astronomical prize, the odds of winning stand at 1 in 302.6 million, which is about 70 times less likely than getting fatally attacked by a shark. The financial implications become even more striking, considering that only half of the ticket proceeds contribute to the prize pool. Thus, a significant portion of any investment is lost the moment the ticket is purchased. This analysis is presented in the context of critiquing government-sponsored lotteries while discussing wider fiscal matters. Brian Westbury points out how the government sponsors such lotteries while failing to fulfill its fiduciary duties. As evidenced by Fitch's recent downgrade of U.S. Treasury debt from AAA to AA+, Fitch attributed this downgrade to factors such as massive deficits, fiscal deterioration, and erosion of governance. While these downgrades have caused political controversies, the article hopes they will lead to meaningful action. I doubt it. Mr. Westbury raises concerns about the concerning trend of increasing debt, exemplified by the recent $1.1 trillion borrowing by the Treasury in just 2 months. The fiscal predicament is further exacerbated by falling tax revenue combined with escalating spending. This has resulted in a projected deficit of around $1.8 trillion for the fiscal year 23. The author asserts that both political parties share responsibility for the current fiscal situation. I wholeheartedly agree. They should all be lined up and shot. I said that, not Mr. Westbury. To rectify this, both parties must collaboratively address the issue, which will never happen. The piece suggests that while politicians who advocate for reduced spending are making an effort to address the fiscal crisis, reliance on luck as in winning the lottery is not a viable strategy for resolving the budget problem. It emphasizes that a comprehensive approach involving significant spending cuts is necessary before it becomes too late to manage the situation effectively, which I think we're already there. In conclusion, Mr. Westbury juxtaposes the allure of lottery winnings with the need for responsible fiscal governance. He critiques government-sponsored lotteries in the context of broader economic issues, highlighting the need for both political parties to take meaningful steps to curb spending and address the fiscal crisis. And if you believe they're going to do anything about it, I got a bridge in Arizona to sell you. So, all right. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. I hope you have a wonderful evening, and I'll talk to you next time. Adios.